often hear markets referred to as a bull market or a bear market. So let's have a little look at what those terms mean. Now, at a high level, the market is considered to be a bull market when the overall market scenario is positive and share prices are on the rise. A bear market is when the performance of the market is on the decline and share prices are falling. So let's take each one of these in turn. Let's start with the bull market. Now, the commonly accepted characteristics of a bull market are that there is a long-term trend of rising prices and stock prices rise by at least 20%. And that's normally after a drop of at least 20% too. Now, there might still be some short-term volatility and dips in a bull market, but the fall in share prices will be less than 20% and they occur for less than 2 months. So what are the underlying factors then that may make the share prices rise in a bull market? Well, a bull market is a time of expansion. It's a period when the economy is growing, there's rising company profits across the country, and the market value of goods and services are rising. Consumer confidence is high and people are spending, and that tends to lead to a fall in unemployment. So a bull market can be characterized by low interest rates and low corporate tax. Now, during a bull market, investors are willing to take a risk and invest their stock. Now, according to research by Investec, an investment research company, the average bull market lasts 3.8 years. And that's the average time for the stock market to climb from the bottom to its market peak again. Now, the longest bull market on record was 11 years. That was between 2009 and 2020. And that run finally ended with the COVID-19 crisis in March 2020, when equity prices just plunged 12.9% in just one day, and the New York Stock Exchange had to suspend trading several times during that time. Now, for long-term investors, bull markets are a time to stay steady with your investing. If you pile money into the stock market when prices are high, then you could be buying just as prices reach their peak. But if you drip money in gradually, you buy stocks when prices are low, they're high, and everywhere in between. Now, let's look at a bear market. A bear market is when the stock market drops significantly in price and doesn't bounce back for at least 2 months. It often starts with a stock market crash, with share prices plunge quickly over a few days or hours. Now, the exact definition of a bear market varies, but most experts agree that it's when a stock market price dips by 20% and it doesn't correct itself quickly. Now, this can be caused by a whole number of factors, including low investor confidence, an expectation of a global recession, and other economic uncertainty. Now, bear markets can be characterized by a rise in unemployment, falling business profits, lower consumer spending, and slow economic growth. It's the opposite of a bull market. So what happens then in a bear market? Well, bear markets can result in a negative spiral where bad news about the economy leads to investors losing confidence. This loss in confidence leads to many investors to sell their investments and fewer investors buy those shares. Now, that large-scale sell-off of shares causes more investors to lose confidence, share prices fall even further, and it results in that downward spiral in share prices. Now, share prices are often extremely volatile during a bear market. No one knows whether prices will continue to fall or whether they're going to bounce back. And that means that share prices can yo-yo up and down as confidence in the market changes from day to day. Now, an example of the bear market is that beginning of the COVID pandemic. In March 2020, overall, markets fell by 25%. And those problems were even exacerbated by falling oil prices in Russia and the Middle East. But by January 2021, share prices had recovered to the January 2020 levels as many economies started to bounce back. And according to Investopedia, the average bear market is around 9.5 months. So can you predict a bear market? It's unlikely, because investor confidence can change very quickly as new economics factors emerge in the news. It is possible to make money in a bear market if you're a long-term investor, because you can buy stocks at a cheaper price than normal and wait for them to rise in value. However, bear markets can be a risky time to buy stocks and shares because those prices are extremely volatile. It's really hard to predict the bottom of a bear market, and sometimes share prices will remain depressed for a long time. Now, sometimes stock market crashes and bear markets can cause investors to panic, but selling shares when stock market prices are low could mean you'll lose out because you'll be selling up that stock very cheaply and crystallizing your losses. So as ever, ways to reduce risk when investing is not by making short-term decisions, but instead investing for the longer term. As Warren Buffett, that American business magnate and investor, said, it's not about timing the market, it's about time in the market.